Welcome back. Today we're diving into the world of investing and debunking some common myths that might be holding you back. Whether you're a seasoned investor or just starting out, these misconceptions can affect anyone. Furthermore, understanding the truth behind these myths can empower you to make smarter financial decisions and set you on the path to financial freedom. So be sure to stick around as I uncover the reality behind these myths and provide you with actionable insights to boost your investing confidence. I'll also be sharing some practical tips and real-life examples that can help you navigate the investing landscape with ease. So if you're ready to take your investing game to the next level, let's get started.
These lies on my name!
Ever felt like investing is just for hedge funds, large mutual funds, or quantitative traders? I used to think I wasn't smart enough or expert enough to start investing. I feared I'd lose my money quickly and needed to have all these attributes to invest, but that's not true. Take Warren Buffett, for example. He started investing at the age of 11, driven by simple curiosity about investing. He read every book on investing available in his local library. This curiosity led to his great investment journey and should serve as an example that anyone at almost any age can learn to invest without being an expert. You don't need a finance degree or years of experience to start. Many successful investors began with minimal knowledge and learned through practice and resources available to everyone. For instance, you can start by investing in index funds or ETFs, which are less risky and easier to understand. Moreover, there are numerous online resources, courses, and communities where you can learn and ask questions. Platforms like Investopedia, YouTube channels like mine, dedicated to investing, and forums like Reddit's r/investing can be incredibly helpful. It's good to remember that investing is a journey. It's about continuous learning and improving over time, so don't let the myth of needing to be an expert hold you back. Start small, stay curious, and keep learning. You'll be surprised at how much you can achieve, and I'm a real-life example of that.
I be popping bottles, sparkles and champagne.
Speaking of misconceptions, many people believe that you need a hefty sum of money to start investing, but that's far from the truth. You can begin investing with just a small amount. Even just $1 to $10 is enough to start investing. Thanks to fractional shares, you can grab up portions of stocks or ETFs at a very low price. By doing this, you can gradually increase your position, and additionally, over time, this approach can substantially increase your holdings in any particular stock or ETF. Consider platforms like Robinhood, Fidelity, or interactive brokers which allow you to start with very little money. These platforms offer fractional shares, making it easy to diversify even with a small amount of capital. For example, instead of needing hundreds or thousands of dollars to buy a share of a high-priced stock like Amazon or Google, you can invest as little as $5 to own a piece of these companies. Moreover, regular small investments can take advantage of dollar cost averaging, where you invest a fixed amount regularly regardless of the stock price. This strategy helps smooth out the effects of market volatility and can lead to better long-term results. Additionally, many employers offer retirement plans like 401ks, where you can start investing with small contributions from each paycheck. These plans often come with employer matching, which is essentially free money added to your investments. The key is consistency. By investing regularly, even in small amounts, you can build significant wealth over time. The earlier you start, the more you can benefit from the power of compounding, where your investment earnings generate their own earnings. So don't let the myth of needing a lot of money to start investing hold you back. Begin with what you have, stay committed, and watch your investments grow over time.
90% of the time, I have no idea what the fuck I'm talking about.
Now, let's debunk the myth that investing is reserved for the elite. As we discussed, fractional shares and commission-free trading have greatly innovated the world of investing and have only emboldened the average investor. By making trading cheaper and allowing investors to hold fractional shares of a said stock or ETF, the barriers to entry have significantly lowered. Moreover, many robo-advisors such as Vanguard and Schwab provide automated low-cost investment management, making professional portfolio management accessible to everyone. These platforms offer personalized investment strategies based on your financial goals, risk tolerance, and time horizon, all without the high fees traditionally associated with wealth management. Investing is no longer a privilege of the wealthy. With the right tools and strategies, anyone can start building wealth and achieving financial independence. The democratization of investing means that the doors are open for everyone to participate in the financial markets regardless of their initial capital. So don't be deterred by the myth that investing is only for the wealthy. Take advantage of the resources available today, start with what you have, and begin your journey towards financial growth and stability.
You're not that guy, pal. Trust me. You're not that guy.
Is investing in stocks a gamble, or is there more to it? This question is complicated and perfectly valid to ask. You can make huge money or lose huge money in the stock market. It all depends on how informed and educated you are. Simply going all in on a stock or ETF without proper research is indeed gambling. However, what isn't gambling is taking the time to inform and educate yourself about the stock or ETF you're interested in. By doing this, you're better equipped to make sound financial decisions. When you invest with knowledge and a strategy, you're not just rolling the dice. You're making calculated decisions based on analysis, trends, and data. The key differences between investing and gambling highlight why informed investing is not merely a game of chance. Successful investing is grounded in thorough research and analysis. Investors study financial statements, market conditions, and company performance before making decisions, while gambling relies primarily on luck with outcomes that are often unpredictable and uncontrollable. In addition to research, investors use strategy like diversification to manage risks. By spreading investments across different assets, they reduce the impact of any single loss. In gambling, risk management is minimal, with fixed odds and the potential for immediate and total losses. Furthermore, investing is typically a long-term endeavor where investors aim to build wealth over time, benefiting from compound growth and market appreciation. Gambling, on the other hand, is short-term and immediate, with outcomes determined quickly, often within minutes or hours. Another significant difference is the level of control. Investors have a degree of control over their decisions, choosing when to buy or sell and adjusting the strategy based on new information. In contrast, gamblers have no control over the outcome once a bet is placed, leaving the results to chance. Investing requires a solid understanding of various factors, such as how interest rates, inflation, and economic growth affect the market. Analyzing a company's revenue, profit margins, debt levels, and market positions helps investors make informed decisions. Keeping up with industry trends and understanding your own risk tolerance is also essential components of a sound investment strategy. While both investing and gambling involve risks, the approach and mindset make all the difference. Investing with a well-informed strategy and a long-term perspective can lead to substantial financial growth. On the other hand, treating the stock market like a casino and making uninformed decisions is akin to gambling with unpredictable outcomes. By educating yourself and developing a sound investment plan, you can navigate the stock market with confidence and increase your chances of success, turning what some might see as a gamble into a calculated and strategic endeavor.
It's happening.
Isolde. Pump it.
Ever try to time the market? Spoiler alert, it's not as easy as it sounds. Attempting to perfectly time the market can lead to devastating losses or potential gains, but the truth is trying to predict the market's top and bottom is one of the worst strategies you can adopt. The stock market is influenced by countless factors, many of which are unpredictable and beyond your control. Economic indicators, geopolitical events, and sudden market shifts can all impact stock prices in ways that are impossible to foresee consistently. This makes timing the market not only difficult, but also incredibly risky. Instead of trying to buy at the absolute bottom and sell at the peak, you're better off dollar cost averaging consistently. By doing so, you spread your investments over time and reduce the impact of volatility. This helps mitigate the risk of making poorly timed investments and reduces the emotional stress associated with market fluctuations. Moreover, focusing on the long term rather than attempting to time the market aligns with the fundamental principles of successful investing. Historically, the stock market has trended upwards over the long term, despite short-term volatility. By holding onto your investments for an extended period, you can benefit from compound growth and the overall appreciation of the market. Embracing a consistent investment strategy and maintaining a long-term perspective allows you to navigate market volatility more effectively and increases your chances of achieving sustainable financial growth. So instead of betting on buying at the bottom and selling at the top, focus on consistent investing and patience to build wealth over time.
Oh, there's no
And
illegal
on the
drugs in
property.
my garage.
Oh, yes, there is, and there's evidence of it.
Hello there.
Have you ever thought that investing is only for older folks? Well, think again. The advantages of starting young are immense, and I'm an example of that. At just 19 years old, I have significant capital invested and ready to grow. Starting to invest at a young age gives you a head start in the game of wealth building. Compounding is one of the most powerful tools in investing, and it works best with time. When you invest early, your money has more time to grow. The gains you earn can be reinvested to generate even more gains, creating a snowball effect that accelerates your wealth accumulation over time. Young investors also have a unique advantage when it comes to risk tolerance. With a longer time horizon before retirement, younger investors can afford to take on more aggressive investment strategies. This means they can invest in higher risk, higher reward opportunities that might be too volatile for those closer to retirement. These riskier investments, such as stocks and growth-oriented mutual funds, have the potential to deliver substantial returns over the long run. Additionally, investing early instills valuable financial habits and discipline. As a young investor, you learn to budget, save, and prioritize your financial goals. These habits can set the foundation for a lifetime of sound financial management. Moreover, starting young gives you the chance to learn from your mistakes and adjust your strategies, leading to more informed and confident investment decisions as you grow older. Investing isn't just for older people. The earlier you start, the greater the potential for building substantial wealth. By taking advantage of the time you have, embracing the ability to take more risks, and developing sound financial habits, you set yourself up for a strong financial future. So don't wait until you're older to start investing. The best time to start is now. Scared of losing everything? Let's discuss mastering risk management. Investing doesn't have to be stressful. You can take proactive steps to safeguard your investments. First, imagine your investment portfolio as a robust garden. Planting a variety of flowers, fruits, and vegetables ensures that even if one type of plant doesn't thrive, others will continue to grow and flourish, providing you with a healthy and abundant garden. Similarly, by spreading your investments across different asset classes, sectors, and geographical regions, you can reduce the impact of any single investment's poor performance on your overall portfolio. Time is also your ally in investing. Market volatility can be unsettling, but historically, markets tend to recover and grow over the long term. By focusing on long-term goals and staying invested, you can ride out short-term market fluctuations and benefit from the overall growth trend. Understanding what you are investing in can significantly reduce perceived risks. Take the time to research and analyze potential investments. Know the companies, industries, or funds you are investing in, and stay informed about their performance and market conditions. Additionally, it's important to know your own risk tolerance and investment goals. Some investments might be too volatile for your comfort level, while others might be more stable and suitable. Assessing your risk tolerance helps you choose investments that align with your financial goals and peace of mind. Regularly reviewing and rebalancing your portfolio ensures that it stays aligned with your investment goals and risk tolerance. This might involve selling off overperforming assets and buying more of underperforming ones to maintain your desired asset allocation. By implementing these strategies, you can invest confidently knowing you've taken steps to manage and mitigate risk effectively.
Did you break into a house? Did you burglarize a house?
Hell no.
Ever feel like you need to constantly monitor the news to succeed in investing? Actually, it's quite the opposite. While staying informed is important, obsessing over every news update can negatively impact your investment sentiment and decision making. Much of the news is just noise, and if you focus on long-term investing, you don't need to worry about every headline. The financial news cycle is relentless, with countless headlines that can trigger fear, excitement, or uncertainty. Reacting to every piece of news can lead to impulsive decisions that may harm your long-term investment strategy. Instead, it's crucial to differentiate between meaningful information and noise. This is where strong, financially sound companies come into play. These companies will generally weather short-term market fluctuations. By investing in stocks or ETFs with solid fundamentals such as consistent earnings growth, a strong balance sheet, and a competitive market position, you can trust that your investments have the resilience to recover from temporary setbacks. However, constantly following the news can lead to emotional investing where decisions are driven by fear or greed rather than rational analysis. Emotional discipline is key to successful investing. Stick to your investment plan, make decisions based on thorough research, and avoid reacting impulsively to market noise. Instead of following the news constantly, schedule regular reviews of your investment portfolio. Quarterly or semi-annual reviews can help you stay informed about your investment's performance without getting caught up in the day-to-day market fluctuations. During these reviews, assess whether your investments still align with your financial goals and risk tolerance. Remember, headlines often focus on sensational news that predicts economic downturns or market crashes. While these stories can be alarming, they are not always accurate predictors of long-term market performance. A stock might hit a new low due to negative news, but if it has strong financial metrics, it has the potential to recover and reach new highs in the future. By implementing these strategies, you can invest confidently, knowing that you don't need to follow the news constantly to be a successful investor. Focus on the long run, trust in the fundamentals of your investments, and maintain emotional discipline to navigate the market effectively.
Shorty wanna ball with the money sitting.
The big question, is investing as complex as quantum physics? Well, not quite. Starting with simple investments into funds like VOO, which tracks the S&P 500, is a great way to get a feel for being an investor. These types of funds are straightforward and provide broad market exposure, making them ideal for beginners. They allow you to invest in a diversified portfolio of large, stable companies without needing to pick individual stocks, which can be intimidating for new investors. Once you are comfortable with this, you can gradually expand into other strong-performing stocks and ETFs. Think of it as wading into the shallow end of the pool before venturing into deeper waters. By starting with a broad market index fund, you are learning the basics of investing, understanding how markets work, how to buy and sell, and how to manage your investments. As you gain confidence and knowledge, you can start exploring more specific investments. For example, you might look into sector-specific ETFs, which allow you to invest in particular industries like technology or healthcare. You can also begin researching and investing in individual stocks of companies you believe in. This gradual approach helps you build your investment skills without feeling overwhelmed. Additionally, there are numerous resources available to help you along the way. Books, online courses, financial news, and investment forums can provide valuable insights and education. Many brokerage platforms also offer tools and educational materials designed specifically for beginners. By taking it one step at a time, investing becomes a manageable and even enjoyable process. You'll discover that while there are complexities, the fundamentals of investing are accessible to everyone. With patience, education, and a gradual approach, you can confidently navigate the investment world and build a strong financial future.
Well, anywho, can I have $40,000?
Think you need expert guidance to get started with investing? That's not the case. This is a huge misconception. Investing can seem daunting, but it can also be incredibly rewarding. Taking control of your own finances rather than relying on someone else is a great way to go. Many financial advisors charge fees that could otherwise be invested. By managing your own investments, you can save on these costs and potentially grow your wealth more effectively. Moreover, taking control of your finances and making investment decisions on your own can provide you with immense confidence and a greater sense of control over your financial future. Here's how you can get started. Develop a strategy that suits your financial goals and risk tolerance. Whether you aim for growth, income, or a balanced approach, having a clear plan helps you stay focused and disciplined. Adjust your plan as needed, but keep your long-term objectives in mind. Utilize modern investment tools and apps that simplify the process. Many of these platforms offer features like automated portfolio management, risk assessment tools, and educational content to help you make informed decisions. Managing your own investments can increase your confidence and give you greater control over your financial future. You'll gain valuable experience and knowledge that will serve you well in the long run. By following these steps, you can successfully navigate the world of investing without the need for a financial advisor. Investing on your own not only saves you money, but also empowers you to take charge of your financial destiny.
You've reached your limit on talking. Shut the fuck up.
Investing doesn't have to be daunting or stressful. It's about starting small, learning along the way, and building your financial future. By taking control of your investments, educating yourself, and using modern tools, you can confidently navigate the investment world and achieve your financial goals. Remember, every successful investor started somewhere. Whether your journey has already begun or is about to begin today or tomorrow, it's up to you. Anyways, guys, that'll be all for today's video. I'd love to hear from you. Share your thoughts or experiences with investing myths in the comments below. And don't forget to subscribe for more content and practical investing tips. Next week, I'll have a portfolio update, so stay tuned. Anyways, guys, I'll see you guys in the next video.